When people always ask me, what's the biggest risk? I've always told them the biggest risks are risks that even I don't know that they exist. If you actually look at the last 8 years, we haven't had a single calendar year in which the market actually closed negative. When people ask about capex cycle, and the memory always goes back to 2003, 2000 and maybe 10 or 12, depending on how you want to look at that period, that was not a capex cycle. That was a once in a lifetime super capex cycle. The number of demat accounts in India did not go up for almost 15 years from 1999 all the way till about 2014. Right? If you actually count, there was barely any growth in the number of demat accounts. And then suddenly in the last 6 years, it goes ballistic. In the US, they call it ambulance chasers, right? So they see an ambulance running somewhere, there's a problem, you go chasing those people, right? So similarly for me, when I see an accident in a sector or I see dramatic underperformance in a sector, I actually think opportunity.
Hello and welcome to another edition of Market Cafe. I'm your host, Surabhi Upadhyay. The banking and financial services sector has really underperformed the market in the last 1 year in a big way. To add to this, the Reserve Bank of India has now really stepped up its regulatory scrutiny of the sector. It's looking at deficiencies in the digital architecture. It's looking at any instance where compliances are not being met. And all of this has led to a lot of volatility on BFSI stocks. Now, despite this, the guest that I'm going to speak to today is actually very bullish on this space, and he thinks that big money can be made here over the medium term. I want to find out what makes him so confident. So let me go and introduce you to Vetri Subramaniam, CIO of UTI Mutual Fund. Vetri, what a pleasure it is to be seated here with you. We're not in the studio for a change. We're not talking on Zoom for a change. And we're here for a sit down. So first of all, thank you so much. And I know you're a really busy person. So thank you for making the time.
Thank you. I mean, the offer of coffee and doing it in person, which I haven't done since maybe pre-COVID. So I said, why not?
I'm glad you decided to do this on Market Cafe, because the whole idea is coffee and conversations and some markets here and there as well. So folks, now, for those who haven't followed Vetri's latest views, he is a little cautious on the market, and we'll get to that in a bit. But the primary purpose behind this conversation today is to understand why Vetri feels that perhaps investing in financial services businesses is still a good idea in this market, despite the volatility, despite the jitters and elections and so on and so forth, and macros and global. Why BFSI perhaps still makes sense. Vetri, I must say you've chosen a tough one, because I was looking at the underperformance, and the financial services index or the bank nifty is up 10% in the last 1 year. Nifty is up 20%. Mid caps are up 50%. Small cap index is up 60%. So let's start with a broad canvas sort of perspective on why you're cautious in general.
Cautious only because, Surabhi, I think, a lot of the good news is in the price. And valuations are what gives me some cause for concern. If you start to extrapolate on an Excel sheet, you can pretty much extrapolate anything out for 24 years. And, obviously, there is every reason to believe that, the targets that we have, Viksit Bharat, so on and so forth, are things that can be achieved. But life is always a lot more cyclical. And I think people are ignoring the risks that are potentially cyclical and just focusing on that extrapolation of what can happen over 10 to 15 years. And to my mind, when people always ask me, what's the biggest risk? I've always told them the biggest risks are risks that even I don't know that they exist. But valuations have actually proven to be the best way to prepare yourself rather than to predict when something can go wrong. And the valuations are telling me this is a time to be cautious.
Fair enough. Well, we promised you coffee, so here it is.
Thank you.
You've seen so many cycles. You've been in this market in various sort of capacities for over 30 years now. What we've seen since COVID, a near one-way run where everything you touch, almost everything turns to gold, and corrections are like 5%, 6% max. Is there a parallel that comes to mind? What do you think of this last 3-year journey?
Two ways to answer that, Surabhi. I think if you actually look at the amount of distance the market has traversed, I would say, in my 30 years, I've seen a market traverse a lot more in terms of gains over a much shorter period of time. So it's not a mind-boggling rally in terms of the distance that it has covered or percentage gains it has delivered over time. You will find many more instances in the past where it's done more in a shorter time.
Okay.
But I think what's been unusual about this one is been, as you rightly pointed out, the lack of volatility. So it's sort of tended to be just up, up and up, and nothing meaningful in terms of pullbacks. And actually, I would say it's not just the last 4 years. If you actually look at the last 8 years, we haven't had a single calendar year in which the market actually closed negative. And people did sort of go through the COVID drawdown fairly well. But I also think one reason why people went through the COVID drawdown well is that there were other pressing matters that were taking their attention, which was literally life and livelihood. And, you know, the markets, by the time they got to look back at the markets had already sort of got through its worst period. But what is more tricky for people is dealing with a market which goes nowhere for a while. And people have not experienced that.
We've not seen
that
that
is
in a while,
something
yeah.
which, I worry about.
Okay, so we'll talk about how to deal with that scenario if it arises, where we just get a very ranging market. Please let me, allow you to have a sip of your coffee. The other thought that comes to mind is, how investors are approaching this, because, or maybe mutual fund investors are actually the smartest lot. Because what we've seen, and I was looking at the data just, yesterday, gradually net inflows that are coming into pure equity funds, they have been declining. But hybrid funds are getting a lot of, inflow, particularly like multi-asset funds, which a lot of you guys in the mutual fund industry are really pushing now. So is that the way to go, given your concerns?
Yes and no, Surabhi, because, we would still tell people that if you are investing as per your financial goals, and you've sort of designed a plan which requires you to have an equity allocation, then actually you should stick to doing that through the SIP route.
Okay.
Right? You don't move away from that. There's no point really doing an SIP in an asset allocation scheme, honestly. We would actually use the asset allocation schemes to say that if you have a large amount of money that you need to deploy, but you're looking at the valuations, and we are also saying we are cautious at these valuations, then use the hybrid schemes, because in many of these hybrid schemes, we are doing the asset allocation in the background. So even if you're investing a lump sum amount, not all of it will go into equity.
Correct.
We have our model, which currently is maybe allowing the equity exposure to be somewhere in the 47 to 50% range, whereas the product could actually have equity exposure as high as 90, as low as 30, right? So that's an indication of where we think valuation is. So the hybrids are something that we are positioning to say, if you've got a lump sum, you need to make that investment today. Consider this, because we will take care of the asset allocation risk for you. The other reason why we are actually finding some bit of traction in the hybrid, Surabhi, is, and I've been surprised by the extent to which investor attitudes towards fixed income have become very, very adverse after the budget change 2 years ago, where fixed income investments taxation rules changed. But there is a category of hybrid funds which runs with fairly low equity exposure and has slightly more favorable taxation. So that as well is a category of hybrids where we are actually telling people that, okay, if you want that, a little bit of equity exposure you can live with, but it's still more stable, then go to that, because the tax treatment there may be something that you will find advantageous.
Let me plug the other show that I do right here, because if you want to know more about this, Let's Talk Money is a personal finance show. And, we're going to have a full classroom on hybrid funds and why they're doing well and how does it work and the tax advantages that Vetri is speaking of. All of that coming up in Let's Talk Money. But for the purpose of this conversation, Vetri, let's get down to the theme at hand, which is banking and financial services, these stocks. I think the market has been waiting for that big move in financials to happen for a while. As I said, the underperformance is pretty telling in the last 1 year. What makes you confident about them despite this long waiting period and the underperformance?
Sure. So, Surabhi, I'll go back to, where you started this, which is you said, it's not doing well. Look, the way my brain works as an investor, I love looking at stuff which is not doing well, because what I've learned in investing over many, many years is that the opportunity is when something is not doing well, the opportunity is when something is being ignored, and that is when you ask yourself, are these valuations giving me the opportunity to get in at a very, very attractive level, right? So it's just the frame of reference I have, that is, there is, like in the US, they call it ambulance chasers, right? So they see an ambulance running somewhere, there's a problem, you go chasing those people, right? So similarly for me, when I see an accident in a sector or I see dramatic underperformance in a sector, I actually think opportunity, right? So that's the way I'm conditioned to think. And therefore, for that very reason, banking and finance really stands out, because what I see over here is a business which has not really had any big issues in terms of their actual performance. It's been sort of more news flow, some of it has been regulatory, and some of it has been, I would say more on the sidelines rather than the fundamentals of the business. And that's actually ended up creating a valuation opportunity, which to my mind is actually, I would say it's one of the few opportunities I do today where I feel positive in terms of absolute returns, not just relative returns.
That's pretty interesting. Would you consider yourself to be a value investor, a value stock picker?
Pretty much that's
Pretty
my
much that's been your style,
conditioning.
right?
So yeah, that's why I'm an ambulance chaser. That where there's a problem is where I want to go.
Okay, so let's just dive a little deeper into this. As you're saying, in terms of valuations, that's one positive. Also, how far away are we from, so let's say the mean, the average at which the sector has traded at?
Sure. So actually, if you look at, and we prefer to look at most of the lending stocks in terms of their price to book, these are pretty much some of the lowest price to book ratios that we've seen for the aggregate, sort of sector. I don't like to specifically focus just on price to book because the sector is quite unique. One of the things I'll point out about the BFSI sector, you look at the benchmark index, and I was talking to Preeti, our fund manager who runs this, the benchmark is a 20 stock benchmark. The number of stocks that we can look at for the BFSI fund is 120 stocks. Right. So there's a big sort of, I'm not sure there are too many other sectors which have this kind of spread of names. So therefore, those valuation metrics have to be seen at a sub-segment level rather than just as a single aggregate, obviously. But the banking sector, if you look at it, which is the heart and soul, because that's like 65-70% of the sector, these are pretty much some of the lowest valuations we've seen going back a decade.
So
I
remember
would argue
3 times
attractive.
Price to book, 3.5 times price to book era, and I guess at least we're not there. So, okay, so check mark on valuations, but now let me come to the other issues at hand. You mentioned regulatory, right? It's become almost a weekly feature that we are dealing with breaking news on RBI saying something on unsecured lending, RBI saying that, okay, project financing norms need to be tightened, you need to set aside more provisions because you need to create buffers, for the next cycle. Or individual entities, right? It could be a Kotak bank, and size doesn't matter. It could be a Paytm one day, it could be a Kotak bank, it could be a small NBFC. The RBI is watching everything like a hawk. Now, I'm not arguing against that. Maybe that's a fabulous thing that, the RBI is really making sure that the guardrails are in place.
Correct.
But from an investor perspective, hasn't this, completely opened up a whole new metric to track?
Sure. You're right, but again, it goes back to what I said, a little bit of that ambulance chasing. I mean, go back and look at what was the news flow in 2015, 16, 17. It was all about the asset quality review. It was the amount of NPS that the banks had to, sort of start to recognize. And look, if you had acted at that point of time, the kind of returns you've been able to make since that period. Here, I would say if you think about RBI, the thing which attracts the most attention is monetary policy. Next is what they have to say about loans and non-performing loans and credit growth. And the area which actually gets the least attention is more the fine-tuning of regulations. And maybe because we've already done so much on inflation and so much on cleaning up the health of the bank books, that today the regulator is a lot more focused on issues related to technology and processes. But again, to my mind, this is actually an opportunity because if these people, get their act together, they're able to clean it up. And I think RBI has been quite a lot more onerous than they have been in the past in terms of taking actions against entities. I actually think it just ends up making the system a lot more stronger. Yes, individual entities may have a setback for a year or two. We heard Kotak talk about the impact, though they said it would be quite limited in terms of their ability to grow. But that's fine. We are playing the theme. Maybe for a year or two, some other bank will benefit at the expense of one bank. But I don't think it changes their medium-term growth prospects. And I think I just look at it as at one point of time, RBI's focus was clean up the bank books, monetary policy. And I think right now they're just saying, let's solve particularly the technology and fraud related angles, and anything which makes the system secure is welcome. One final point over there, whenever you tighten these guidelines, actually, I always believe incumbents benefit. And remember, one of the unusual things about BFSI is one of the few sectors where entry is very difficult. particularly in banks, I mean, there is no new licensing, right? So it's tough for new competition to enter. So BFSI in India actually has a wonderful regulatory advantage, which is there is no free entry. Right? You want to start a telecom company, media company, mutual fund company also can be done, but banks,
I can't start a bank.
Yeah, you can't.
No, very true. So just to take this point further on the RBI action, and like you're saying that the impact would be different for different entities, but right now, is there anything that concerns you a little more, because they're going after banks and NBFCs where there's a digital mismatch, right? Which was the case with Kotak. They're going after wherever compliances are not in place, gold financiers, what we're seeing. Then they're already looking at avoiding another bad credit cycle, which is where the additional provisioning perhaps kind of comes in.
Sure.
So because of this, is there any particular one sector or two sectors within BFSI which you think will be impacted a little more? So maybe, from an investor return perspective, or
honestly, no, I don't see it that way. And I think the most attractive part of this is the core banking franchise. Because if you look at it, over the last 5 years, credit growth, deposit growth, more or less aligned with nominal GDP growth. Even if I crunch the numbers over 10 years, it will look the similar. If I crunch it over 20 years, credit growth historically has been about 1.2 to 1.5 times GDP. But go back and look at the middle decade of the 2000s, credit growth was actually almost 2x of GDP, right? So if we are talking about India's sort of growth rate at 6.5% in nominal terms, maybe 10 odd percent, in real terms, 10 odd percent in nominal terms, it's very easy to see credit in India growing at somewhere between 12 to 14% per annum over a sustained period. Now that creates a fantastic backdrop for the banks to actually generate profitability. And when we talk about all these things in terms of income levels going up, companies wanting to do capex, it's actually a wonderful environment for the banks to go out there and being able to lend money to people who are wanting to borrow because their own standard of life is improving, their incomes are improving.
Now, here's the question. By the way, my standard running joke in the office almost every week is that nowadays the RBI moves the equity market more than it moves the money market, because of the reasons that we're discussing, right? You mentioned credit growth. I was looking at the numbers that the central bank put out for the year that closed, FY24. So, system-wide credit growth for FY24, 16.5%, roughly 16.3%. But here's the thing. When the RBI slammed the brakes on unsecured lending, personal loans, credit cards, and the RBI is very cautious on that, those numbers have come down quite substantially. Personal loan growth has slowed down to about 17.7% versus 21% in the previous year, FY23. And if we talk about loans to NBFCs, another area where the RBI is kind of clamping down to ensure that there's no overheating, loans to NBFCs have come down to 15% in FY24 versus almost 30% in the previous year. Just some trends we thought we'll highlight for our viewers as well. Now, where will growth come from? Because that whole corporate credit cycle, I don't know, tell us if you think it's going to pick up. The RBI is saying don't go overboard with this unsecured whole retail loan credit card business. So if I'm an investor and I want to buy in to ride that next wave of bank growth or NBFC growth, then what am I looking at in terms of which sector is going to drive it?
Sure. I think it will be a combination eventually. It will be a combination of both household as well as corporate credit. And I'm not even considering, when people ask about capex cycle, and the memory always goes back to 2003, 2000 and maybe 10 or 12, depending on how you want to look at that period. That was not a capex cycle. That was a once in a lifetime super capex cycle. Wow. I don't know if I will ever see something like that again.
You don't see that coming back?
It was very unusual. There was a confluence of global and local factors which made it possible. I don't know whether it will happen again in my lifetime. I'm sure it will happen again at some point, but that was very, very unusual. But if you're talking about a regular capex cycle as different from that super capex cycle, I think it is already some signs of that are there. And remember, corporate India has also learnt its lessons. So neither do they have a desire to go overboard. And honestly, we as investors are equally cautious. So, if companies really come to us with very large capex plans, we're like, hold on, why are you doing this? Why are you putting the enterprise at risk? But that is not to say there is no capex happening. It's certainly happening. And I think many of the policy initiatives which are targeted at sort of raising the share of manufacturing will lead to a slight pickup in capex. and those will lead to the creation of organized sector jobs. When individuals have visibility of their income coming in, that makes them good credit for the banks. That gives them the confidence to be able to go out there and borrow, because you now have a visibility of a cash flow stream coming into you. So I actually think the setup is very, very good for sustained growth in credit. And again, we are not talking about credit growing at 20% in a nominal GDP of 10%. But can it grow 10 to 14% as GDP expands? I think it can, and that's the simple play that we are looking for. So we are not looking for that once in a lifetime
super
boom.
cycle.
Yeah,
Okay.
no super cycle.
Okay, got that. So banks are a yes for you, PSU, private sector, or both?
Yeah, so that's an interesting question. And I just want to highlight one thing over here, and I was looking at the data. If you look at the last decade, right, the PSU banks have had to raise equity of 4.5 lakh crores to recapitalize themselves to be fit for business.
We all remember that time, 2016, 17.
The private banks over this decade have raised about 1 lakh crore, right? Then you look at what's the kind of profitability that these banks make. In 23, these PSU banks, which put together had to raise 4.5 lakh crores of equity to recapitalize over a decade, made a lakh of profits. The private banks, which raised 1 lakh over a decade, made a lakh and 70 in a single year, right? So my simple point is that the private sector banks, not every one of them, just like it would be unfair to say that every PSU bank doesn't have the capability to generate ROA, but the ROA of many of the private sector banks is superior. What it means is their ability to absorb credit costs is superior, and that's a very important point today, Surabhi, because underlying my bullishness on BFSI is that credit will grow, but at some point even credit costs will start to go up. And when credit costs start to go up, you need a bank which has the ability and the cushion to be able to absorb those credit cost hits when they come. And I think over there, the private sector has demonstrated a lot superior track record. But I honestly think of the banks today as the big six, which is 1 PSU and 5 private. And I think they've all got metrics which give us a great deal of confidence.
Okay, so that's about banks. Now let's talk about non-banks, capital market businesses. A lot of new businesses which have really come of age in the last 10 odd years. Actually, the capital market side of it first. Broker stocks, wealth management stocks, they're just shooting through the roof. We know the narrative because we're getting wealthier and we want to invest, and I want to invest, and I want a stockbroker, and etc. But again, how much of it is real, tangible? Where do the valuations still make sense? How do you play this piece?
This is the hard part about forecasting, Surabhi. Just to do a little bit of throwback in history, I was part of a online broking startup way back in 99-2000. We used to estimate the number of equity investors at 1 crore, and the number of demat accounts in India did not go up for almost 15 years from 1999 all the way till about 2014. Right? If you actually count, there was barely any growth in the number of demat accounts. And then suddenly in the last 6 years, it goes ballistic. Right? So talk about being at the wrong place at the wrong point of time. But it's been incredible, I think, in terms of the growth that's happened, 15 crore demat accounts. But Indians' exposure to equities and mutual funds is just about 7% of household financial assets. And I would say even in a developed country like Germany, which does not score very high in terms of its penetration of financial products, it's actually 20% plus. And you look at a country like Chile, which has got a very well developed pension system, 30%. A lot of the East Asian countries are 20-25. So I think there's a good runway there in terms of growth opportunity for them. Yeah, but you need to be a little bit careful of valuations. If the number of demat accounts has gone up 4x in the last 4 years, I do worry about the fact that they've not seen a bear market, and we'll have to see how many of them decide that this was a hobby during a bull market, but I don't know how to tolerate a difficult period.
But how are the valuations? I mean, do the stocks still offer some upside, or
there
are they already
still a few businesses that we like, but I would say harder to find there. My bigger attraction is more in core banks, some of the NBFCs, some of the non-life insurance. I would say the capital market plays sort of follow after that.
So banks, you said NBFCs and non-life
all lending
insurance.
businesses, non-life insurance again I think is a very interesting space to be. The Indian economy is very, very under-penetrated in terms of non-life insurance. Actually, life insurance penetration rates in India are not too low, but non-life is very, very low, and I think that's a growth business. And as soon as people have incomes and businesses where they cannot afford to deal with the risks that nature poses, that events pose, what do? You start to insure. Right. So actually, I think that's the side of the business, the non-life insurance and health insurance, which we feel very, very strongly about. If you look at the share of medical expenditure which people in India do out of pocket, which means it's not coming out of insurance, it's as high as 50 to 60%. But I think there's a great opportunity to sell medical insurance to people. So health insurance and non-life, the fire, the auto and all those, those are the areas which we think are structural
the
growth
rate at
story.
which my own health insurance premiums are going up every year. I mean, I'm sure there's an investment case here. But again, same question. Stocks still offer some value?
In the non-life, yes, we think actually it's attractive. In the life space, actually, stocks were far more expensive 3 years ago. Incrementally, I'm a lot more positive there. They're dealing with a lot of changes which have happened, tax code, business, regulatory changes. But from my point of view, what is that doing? It's bringing the valuations down. So I'm just waiting for the point where we could get more constructive on them. But the valuations in life have certainly now come to more reasonable levels compared to 3 years ago. If you just go back actually, Surabhi, to somewhere, just around the pandemic or immediately post-pandemic, this financialization was like a term which you opened the newspaper, you looked at the TV, everybody was talking financialization. Believe me, the life insurers and the AMCs have done nothing since then. Right?
Exactly.
And that's the reason I say that, you have to be conscious of valuations, because at that time, the valuations didn't give you anything on the table.
Right.
But today you've had 3 years where those businesses have, they've grappled with challenges, they've grown, and the prices and valuations have actually come down. So to my mind, incrementally, life is an area from a valuation perspective, we are getting constructive.
Got it. That's a full classroom on BFSI and a really helpful one. But as we come down to final thoughts, I want you to leave us with the overall advice for investors who are either coming in now, and I think you've already halfway solved it for us, because a lot of people are sitting on the sidelines with that lump sum saying, "Arey, correction aayega, then we'll put money." Correction is not coming. So you've offered the advice on hybrids over there. But in general, anybody who wants to enter now, what is it they should keep in mind, and what's the route they should take?
Sure. Look, I think there are some rules in investing which are simple, but they are eternal. They were as valid when I started my career 30 years ago. They are still valid today. The first one is diversification, right? You don't back a single stock, you don't back a single mutual fund. I mean, unless you're doing like a Nifty 50 and saying I hold the old index, so it doesn't matter. But you don't back one single thing. You diversify across asset classes, you diversify across market cap. If you're doing single stocks, you diversify across a portfolio of stocks. If you're thinking styles, you diversify across styles, value, growth, quality, momentum, whatever. So that's one principal rule: diversify, diversify, diversify. I think people underestimate the importance of N in the formula for compounding, because everybody looks at that formula for compounding and is focused on R, which is the rate of return. But the most underrated part of the compounding formula is actually N, right? Because the N is what really creates the magic.
The years.
The years.
Number of years.
Exactly. So the trick is to remain invested at a reasonable return for many years, rather than to say, I need to be at the most happening party every night and that's how I'm going to get rich. Right? So diversification is the key to ensuring longevity and survival. Point number 2, don't leverage. Right? I mean, there will be people every now and then who get lucky and say, I leveraged and I got rich. But, that's the story which makes it to the headlines. The ones who lost everything by leveraging, those stories don't make it to the headlines. So I've learned and I've seen people lose money courtesy leverage. So I would say, when you're investing, remember, your primary purpose is to have a profession, a job, a business. That's where you bring in the income from. You save something, you then invest it, you don't leverage it.
Got it.
So these, I would say, are the 2 fundamental principles, I think, which just don't go away.
I really hope people keep them in mind. And before we sign out, I have to ask you this question. It is election season. Given that everything's happening around us and the noise and the high decibel sort of, exchange of views that's going on, and the recent market volatility, does all of this at all make you worried, or does it give you any sleepless nights at all? I mean, hypothetically, if there is a unfavorable outcome or whatever, but how should we look at this mega election?
Well, actually, in some senses, as you rightly said, this is the most boring election I've come across in a long time, because everybody sort of feels, okay, we know what the outcome is going to be. All I will say is, look, this journey, even over the last 30 years that I've been in the market, we've seen governments fall, we've seen governments change, we've seen election surprises. You need to have confidence in the fact that the country's platform is solid, and we are driven by the aspirations of businessmen, of individuals, of people going to work. And it is that positive cycle of aspirations which drive the economy, combined with everything which is good regulations, opportunities, so on and so forth. So, I'm very positive that that cycle will continue to play, because it's played out for the last 30 years.
Yeah.
And I look back, Surabhi, I was born in 1970. Right, 5 years after I was born, the country had something which was known as the emergency, right? And I wonder how my parents thought about it at that point in time. But look, it's all worked out well, right? So I think I'm an optimist in terms of human progress and about the capability of India to progress. There will be cycles within that, but nothing which should really cause you to step away from the act of investing.
Excellent, optimistic note to end on, and a very useful conversation. Vetri, we really appreciate you taking out the time and joining us on the show today. Thank you very much.
Thank you. Thank you.
Well, that's it on this conversation. We'll soon see you with another one. Thanks for being with us on The Market Cafe. Thank you for watching CNBC TV18, and do follow us on all our social media platforms for news, updates, and more.